U.S. Treasury Secretary Janet Yellen tried to save face and point the finger at Fitch, accusing the company of processing irrelevant data. That's after the international rating agency cut Washington's credit score, citing concerns over the country's debt burden and state of finances, as well as an erosion of governance.
In Fitch's view, there has been a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters, notwithstanding the June bipartisan agreement to suspend the debt limit until January 2025. The repeated debt limit political standoffs and last-minute resolutions have eroded confidence in fiscal management.
Fitch's decision is puzzling in light of the economic strength we see in the United States. I strongly disagree with Fitch's decision, and I believe it is entirely unwarranted. Its flawed assessment is based on outdated data and fails to reflect improvements across a range of indicators, including those related to governance, that we've seen over the past 2.5 years.
This is the second major rating agency after Standard & Poor's to strip America of its AAA rating. The news has spooked investors across the world as global stocks began to slide. Washington lost credit points despite the U.S. government's last-minute deal on raising the debt ceiling. That's as the country's debt has hit a record high, reaching over $31 trillion. RT contributor Chris M. says the U.S. is overwhelmed with debt and is dragging Washington's allies in the West down the road of economic decline.
And by seeing that, I think you'll see big American companies that have investments across Europe, across Asia even. You know, let's not forget Australia, for some reason, has decided to ally itself economically to the US. A little bit of Chinese involvement, but most the US. I think, yeah, we can see, you know, a decline in ratings for all of those countries that depend more or less solely on US commerce. Let's just put this agency into perspective. It was founded in the 1900s in the United States. It wasn't invented yesterday. It's incorporated in the UK, in London, and in the USA. There are only two offices globally, their main headquarters, if you like. And what they're basically saying is, look, if you print loads of money over the course of the last couple of decades, if you mismanage your economy to an extent where you've just depleted your entire military reserves and sent them to fight a conflict, you know, thousands of miles away from you that has nothing to do with you, this is the result of your economy. The economy is in tatters. The lack of clear policy making done by the Biden administration, that comes from the whole infrastructure bill, which was meant to be the big thing that Biden was going to get done. We don't hear any more about that. That, you know, he was going to improve all of that infrastructure, which is dilapidated within the US. All we hear about is that he's printing more money and then giving that money to Ukraine. And that's not very good if you're looking at investing money in an economy, because you can't see the output of those funds. You can't see a return of investment in the United States economy right now. You know, this is just another nail in the coffin for the dollar, I think. I mean, we had the Russia-Africa Forum here in St. Petersburg last week. We saw the number of African countries, global South leaders, talking about ditching the dollar and embracing their own sovereign currencies, maybe even the BRICS nations creating their own BRICS coin or BRICS currency, similar to kind of the euro. If that happens, I mean, this is just another incentive for a central banker anywhere in the world to look at alternative currencies to use for global reserve trade.